Picture this. You wake up on an ordinary Tuesday morning and your phone buzzes with a push notification that makes your stomach drop. Breaking: United States national debt officially surpasses $100 trillion. You blink at the screen twice because the number does not even look real. 100 trillion, 12 zeros. More money than every stock on the S&P 500 combined, more than 3 times the value of the entire United States economy in a single year. Cable news anchors are already shouting over each other. The futures market is flashing red, and somewhere in a glass office tower on Wall Street, a junior trader is refreshing his terminal every 4 seconds, because nobody actually knows what happens next. This is not science fiction. It is not a hypothetical dreamed up to scare you into clicking a video. The United States government has already spent more than $100 trillion on debt interest alone over the next 30 years, according to official congressional projections. And independent economists at places like the Penn-Wharton budget model now argue that if you count the money the government has promised but not actually saved for, like Social Security and Medicare, the real fiscal gap is already sitting somewhere around $100 trillion today, not in some distant future. So let's not treat this as a fantasy. Let's treat it as what it actually is, a slow-moving wave that is already rolling toward the shore, and let's walk through exactly what it looks like when it finally makes landfall. Meet Sarah, 38 years old, a nurse in Columbus, Ohio, married with 2 kids, a mortgage, a car payment, and a modest 401k she checks maybe twice a year because looking at it too often stresses her out. Sarah has never read a congressional budget report in her life, and she never will, but Sarah is about to feel every single decision made in Washington in ways she cannot ignore. It starts quietly. It always does. The morning the headline breaks, nothing in Sarah's life changes. Her alarm still goes off at 5:45. Her coffee maker still works. Her kids still need lunches packed. But 3,000 miles away in bond trading rooms in London, Tokyo, and New York, something very real is happening. Investors who buy United States Treasury bonds, the IOUs the government sells to fund itself, start asking a question they have asked with increasing frequency for years now. Is lending money to the United States government still as safe as it used to be? When that question gets asked enough times by enough large institutional investors, the answer shows up in the yield, the interest rate the government has to offer to convince people to keep buying its debt. Higher yields mean the government has to pay more to borrow, and here's the part most people miss. That same Treasury yield is the invisible thread connected to nearly every loan in the American economy. The 10-year Treasury yield is the benchmark that mortgage rates are built on top of. When it rises, so do mortgage rates, almost immediately. Analysts have already tracked this relationship for years, watching 30-year fixed mortgages track upward in near lockstep with Treasury yields, even while the Federal Reserve talked about cutting rates. Sarah and her husband had been quietly saving for 2 years to move into a bigger house before their oldest starts middle school. They had a number in their head, a monthly payment they could live with. But as the debt spiral accelerates and yields creep higher, that number becomes fiction. The mortgage payment on the same house jumps by $200, $300, sometimes $400 a month, not because the house changed, but because the cost of money changed. Multiply Sarah's story by millions of families across the country, and you start to see home sales slow, construction crews get smaller shifts, and an entire housing market that quietly stalls out, not from a lack of demand, but from a lack of affordable credit. Meanwhile, at the small manufacturing company where Sarah's husband works as a supervisor, the owner is having a very different conversation with his banker. He wanted to take out a loan to buy new equipment and hire 6 more people. His banker tells him the rate has gone up again. Businesses across the country begin scaling back expansion plans, delaying new hires, and in some cases quietly laying off workers because borrowing to grow the company no longer makes financial sense. Economists call this crowding out, a fairly dry academic term for something that feels very personal. If you are the person who does not get the job, the raise, or the promotion because your employer cannot afford to expand. The Penn-Wharton budget model and the Brookings Institution have both published research showing that when government borrowing eats up a larger and larger share of the nation's savings, there is simply less capital left over for private businesses to borrow and invest, which over time translates into slower wage growth and fewer opportunities, especially for younger workers just entering the job market. Now here is where it gets even more uncomfortable, because the story does not stop at Sarah's mortgage or her husband's job. It reaches directly into the government check that Sarah's own parents depend on every month. Her mother, 71 years old, retired after 30 years as a school teacher, relies on Social Security for most of her monthly income. According to the most recent official trustees report, the Social Security Retirement Trust Fund is projected to become insolvent by the end of 2032. And when that happens, the law requires an automatic across-the-board benefit cut of roughly 22 to 24%, unless Congress acts before then. Independent analysis from the Committee for a Responsible Federal Budget estimates the average retiree could see their monthly check reduced by around $500, hitting more than 60 million Americans at once, with no state spared from the impact. Sarah's mother has budgeted her entire retirement around a number that the government itself now admits may not be there in full within just a few years. This is not a hypothetical scare tactic. This is sitting in an official government report published in 2026. And it is not only Social Security feeling the squeeze. As the interest owed on the national debt grows larger every single year, it consumes a bigger slice of the federal budget. Money that used to fund roads, scientific research, veterans' health care, and national defense now increasingly goes simply toward paying interest on debt that has already been spent. Net interest payments on the debt were projected to exceed $1 trillion in a single fiscal year, nearly triple what the government paid in interest just a few years earlier during the pandemic. And in some recent quarters, interest payments have already surpassed the entire defense budget for that period. Think about that for a moment. The government is now paying more just to service old debt than it spends defending the country. Lawmakers are left with brutal choices: raise taxes, cut popular programs, or keep borrowing and hope the bill never actually comes due. And every single option carries political consequences nobody in Washington wants to own. So where does this money even come from in the first place, and why does the whole system start to strain the way it does? The United States government sells treasury bonds to investors all over the world, from massive pension funds to foreign central banks. For decades, countries like Japan and China have been among the largest foreign holders of American debt, in part because the dollar has served as the world's reserve currency, and treasury bonds have been considered close to the safest investment on the planet. But that landscape has been quietly shifting. Recent treasury data shows China's holdings of U.S. government debt falling to their lowest levels in nearly 2 decades, and Japan, still the largest single foreign holder, has also trimmed its position. Central banks around the world, especially in emerging economies, have been accumulating gold at a record pace instead, partly as a hedge and partly as a deliberate strategy to reduce dependence on the dollar, a trend commonly referred to as de-dollarization. Gold prices themselves have surged to unprecedented levels, trading above $5,000 an ounce in 2026, a rally driven directly by concerns over sovereign debt, persistent inflation, and a search for safety outside the traditional dollar system. None of this means the dollar collapses overnight. Most analysts are clear about that. The dollar still dominates global trade, and the treasury market remains the deepest and most liquid in the world, but the margin for error is shrinking. And when a smaller circle of buyers is left holding a rapidly growing pile of debt, those buyers gain more leverage to demand higher returns for the risk they're taking on. And the world has already delivered its verdict once, quietly, through the most boring-sounding institutions imaginable, the credit rating agencies. In May of 2025, Moody's stripped the United States of its last remaining top-tier AAA credit rating, following Standard & Poor's back in 2011 and Fitch in 2023, meaning for the first time in modern history, not a single major agency rates the United States at the very top of the scale anymore. Moody's was blunt in its reasoning, citing the growing burden of financing the government's budget deficit and warning that successive administrations and Congress had failed for years to agree on any credible plan to reverse the trend of large annual deficits and rising interest costs. The agency projected federal debt could climb toward 134% of GDP within the following decade, up from around 98% just a couple years earlier. A credit downgrade might sound like an abstract technicality that only matters to bond traders, but it has real teeth. It tends to push borrowing costs higher across the entire economy. And shortly after the downgrade, several major banks saw their own credit outlooks affected as a direct consequence. Back in Columbus, none of this shows up as a single dramatic headline event in Sarah's life. It shows up as 100 small erosions stacking on top of each other. The grocery bill that keeps creeping up even when she buys the exact same items, the property tax bill from the city that rises because local government borrowing costs went up too. The raise she was promised at the hospital that gets quietly delayed a year because the hospital's own budget is under pressure from rising costs elsewhere. Her retirement account statement that swings wildly during weeks when Washington is fighting over the debt ceiling because market analysts have pointed out for years that debt ceiling standoffs and fiscal uncertainty routinely rattle stock markets and bond markets simultaneously. And one prominent estimate from Moody's Analytics warned that an actual government default scenario could wipe out trillions of dollars in household wealth almost instantly. Sarah is not an economist. She does not think about basis points or debt to GDP ratios. She thinks about whether she can still afford summer camp for her kids, whether her mom's Social Security check will stretch through the month, whether the promotion her husband was hoping for is still going to happen this year. That is the real lived experience of a spiraling national debt. It rarely announces itself with a single catastrophic moment. It arrives as friction, as 1,000 small doors quietly closing that used to be open. Now, does this mean total collapse is inevitable, that the United States is doomed to some kind of financial apocalypse straight out of a disaster movie? Most serious economists, even the ones sounding the loudest alarms, say no, and it is worth understanding exactly why, because the nuance here matters enormously. The United States still controls the world's dominant reserve currency, still has the deepest capital markets on the planet, still commands enormous trust built over 8 decades, and still has one of the most productive, innovative economies in human history. A large debt load by itself does not guarantee disaster the way a viral headline might suggest. What actually matters, according to economists across the political spectrum, is the relationship between the interest rate the government pays on its debt and the underlying growth rate of the economy. When an economy grows faster than the interest rate on its debt, the debt burden as a share of the economy can actually stabilize or even shrink over time, even while the raw dollar figure keeps climbing. But when interest rates rise faster than economic growth, and deficits keep piling on year after year regardless of the economic cycle, the math starts working against you in what analysts sometimes call a debt spiral, where rising debt pushes up interest rates, which increases the cost of servicing that debt, which increases the deficit and pushes debt even higher, on and on in a feedback loop that becomes progressively harder to break. This is precisely the dynamic that groups like the Committee for a Responsible Federal Budget have flagged as the central danger of the current trajectory, not the size of the number alone, but the shape of the curve and the accelerating pace at which each new $10 trillion gets added. Where economic history offers real, sobering lessons is in watching what happens to nations that ignore this dynamic for too long. Argentina has cycled through multiple sovereign debt crises over the past several decades, each one bringing brutal inflation, currency collapses, and years of lost economic growth for ordinary families. Greece, back in the early 2010s, saw its debt crisis force savage austerity measures, unemployment above 25% at its peak, and a decade where an entire generation of young Greeks left the country to find work elsewhere. These are not perfect parallels to the United States, which has structural advantages neither of those countries had, control of its own currency and unmatched global demand for its debt among them, but the underlying warning is the same everywhere it has happened throughout history. Debt crises do not usually arrive as a single dramatic morning. They arrive as confidence eroding slowly, then very suddenly, once the market decides collectively that the story has changed. So what would it actually look like if the United States kept drifting deeper into this territory without any course correction, without any serious reform? Picture the next 5 to 10 years playing out along the current trajectory that the Congressional Budget Office itself has already modeled. Interest payments continue consuming a larger and larger share of the federal budget, eventually rivaling or exceeding spending on Medicare. Lawmakers face impossible political choices with every single budget cycle: either cut deeply popular programs that tens of millions of Americans depend on, raise taxes in ways that slow economic activity, or continue borrowing and quietly pass the burden onto the next generation, which is largely the path taken again and again for the past several decades, regardless of which party controls Washington. Mortgage rates settle into a new, permanently higher normal. Real estate professionals have already said publicly they do not expect a return to the 3 or 4% mortgage rates that an entire generation of Americans grew accustomed to, meaning home ownership becomes structurally more expensive for young families for years to come. Social Security reaches its projected trust fund depletion date around 2032. And unless Congress passes reform legislation before that deadline, tens of millions of retirees see an automatic reduction in their monthly benefit checks. A reduction that state-level analysis shows would touch every single state in the country with no region spared. Foreign buyers of American debt continue diversifying at the margins, not abandoning the dollar outright, but trimming exposure and adding gold and other assets, which keeps gradual upward pressure on the yields America has to offer to keep attracting capital. And every so often, usually tied to a debt ceiling standoff or a disappointing budget report, financial markets experience sharp bouts of volatility that ripple straight into the 401k and IRA accounts of ordinary working Americans who had nothing to do with any budget decision in Washington. None of this is guaranteed. All of it is avoidable, at least in theory. Economists across a wide range of political perspectives generally agree on a few broad categories of solutions, even if they disagree sharply on the details in the mix. Spending reform, particularly around the large entitlement programs like Social Security and Medicare, which make up the largest and fastest growing components of the long-term fiscal gap. Revenue reform, meaning some combination of tax policy changes designed to close part of the gap between what the government spends and what it collects. And perhaps most importantly, sustained economic growth, because a growing, more productive economy makes any given level of debt easier to carry, the same way a rising income makes a mortgage payment feel smaller over time, even if the payment itself never changes. History actually offers an encouraging example here too, not just cautionary tales. In the 1990s, the United States ran an actual budget surplus for several consecutive years, driven by a combination of spending discipline, tax policy changes, and one of the strongest periods of economic growth and productivity gains in modern American history, particularly during the technology boom of that decade. It is proof that the trajectory is not physics, it is policy, and policy can change direction when there is enough political will behind it, even if that will has been in short supply for the past 2 decades, regardless of which party has held power. So let's come back to Sarah in Columbus, because ultimately this entire story is about her and about you and about every single person whose paycheck, mortgage, retirement account, and parents' social security check are all quietly threaded into decisions made in a building most of us will never set foot inside. The lesson here is not that the sky is falling tomorrow morning. It is not that you should panic, sell everything, and bury gold coins in your backyard. The lesson is that the national debt, for all its abstract, incomprehensible size, is not actually abstract at all once you trace the thread all the way through, from a treasury auction in Washington to a mortgage rate in Ohio to a retirement check that might get smaller in just a few years. Understanding this does not mean living in fear of a number with 12 zeros on it. It means understanding that your mortgage, your job, your parents' retirement, and your own retirement are all connected to a much larger system, and that the health of that system is not someone else's problem to solve while you watch from the sidelines. It means paying attention to what your own elected officials actually propose to do about it, rather than simply which side of the aisle they sit on. It means being deliberate and informed about your own financial choices, understanding how rising rates affect your mortgage, your savings, and your investments, and building in a margin of safety rather than assuming the environment of the past 30 years will simply continue unchanged forever. Because if there is one thing that economic history keeps proving again and again, from post-war America paying down its wartime debt through decades of strong growth, to the surplus years of the 1990s, to the cautionary examples of nations that let their debt spiral without ever correcting course, it is this: numbers on a government balance sheet do not determine the future all by themselves. What determines the future is whether people, businesses, and governments respond to the warning signs while there is still time to change the outcome, or whether everyone simply keeps looking away because the number is too large and too uncomfortable to fully process. $100 trillion is not a doomsday prophecy. It is a mirror reflecting every choice this country has made and has not made for the past several decades, and every choice that still remains on the table right now, today, before the next headline breaks and the next Sarah wakes up to a mortgage payment she suddenly cannot afford.